Welcome to the channel. My name is Heather. This is Dollar for Dollar, and on this channel, we talk about personal finance tips and tricks so that you can find financial freedom. Let's talk about credit scores today. What is a credit score and how is it calculated? So a credit score is nothing more than a number that creditors, or banks as they're commonly referred to, use to determine not only if you're going to get a loan, but how much you should receive and the likelihood that you will pay it back in full. So basically, this is a number banks use to determine if you are worthy of getting a loan from them. Now, a credit score will typically range from 300 to 850. It can vary slightly depending on who is reporting out that credit, but the most commonly used one by banks is the FICO credit score. So that's the one we're going to use to unpack how credit scores are calculated. Now, you may sometimes hear people say they have a 0 credit score. I just want to debunk that right now. A 0 is technically not possible. What happens when you have a 0 credit score is you actually don't have a credit score. So your score is considered to be indeterminable. They cannot assign you a number. Now, having a score that is indeterminable is not a good or a bad thing per se. It just means you don't have either enough credit history or a long enough credit history for them to really give you a number to determine your credit worthiness. And again, credit here being the amount you can take out in the form of a loan. So just think of that again. A credit score, at the heart of it, is literally saying loan score, debt score. How much will they let you borrow that you can pay back? Think of it that way. That's an easy way of thinking of a credit score, honestly. But you can go from having a credit score to having no credit score because, for example, if you don't take out any more credit and you pay everything off and you don't owe anybody anything, after a while, you don't have enough history there. You can go from having a 700 credit score to having no credit score because, again, what is most important to having this credit score is a history of paying back loans. Well, if you stop paying back loans because you're no longer taking any out, well, needless to say, you can go to no credit score at all. Now, if you have any form of debt or any sort of credits right now, so maybe you have just a mortgage, there's a very good chance you have a credit score of some kind. Now, there is a range, and like I said, 300 to 850 is the most typical, and that's what we're going to use here because we're talking about FICO specifically in this video. But 300 is at the very bottom of the scale, and that is considered bad. And 850 is at the very top of the scale, and that is considered excellent. Pristine credit score. Now again, FICO is often cited as the industry standard when it comes to credit scores, so that's the one we're going to look at here today. And there are 5 things that FICO looks at specifically when they calculate your credit score. Now think of your credit score as a pie, and each of the 5 components we're going to talk about is a slice of the pie. Now the largest slice of your credit score is your payment history, and that weighs in at 35% of your credit score. So what is payment history? Basically, they're looking at how long have you been paying back your loans, and not only how long, but on time. Okay, so consistency is really important here because if you've been delinquent before, if you've had, bad loans, your loans called, you couldn't repay, bankruptcy, things like that, you are going to have a serious ding in your credit score because, again, this is the largest piece of that component. So the second largest slice of your credit score at 30% is the amount of money you owe compared to your available credit. A great example is if you have a $5,000 credit limit for a credit card, but you have maxed it out or you're at $4,800. This is considered to be a red flag because to a lender, you are high risk as you are more likely to default. And the reason they say you are more likely to default is because research has shown that people who are maxed out or have a higher amount of credit being used compared to what's available are more likely to default on loans. Now, within this amounts owed slice of your credit score, there are 5 things specifically that FICO looks at. Number 1, they look at the amount owed on all of your accounts. The second thing they look at is the amount owed on different types of accounts. And the third thing they look at would be how many open accounts have a balance. So what's important to note here is that it's only on your open accounts. A car that you paid off 6 years ago is no longer impacting this piece of your credit score. And the fourth thing they look at, the percentage of your available credit being used on revolving accounts. A revolving account just refers to an account that has a credit limit, like a credit card, for example. And the very last thing, they look at the amount owed on installment loans compared to the original loan. So a great example would be a car payment. Now, the third slice of the pie when it comes to your credit score is the length of credit history, and that comes in at 15% of your credit score. And with the length of your credit history, there are 3 things that FICO looks at specifically. They look at how long you've had your credit accounts. So they look at your longest open account, your newest open account, and the average age of all of your accounts combined. They also look at how long specific accounts have been established because they want to see consistency. And the third thing they look at is the last time you used certain accounts. So you may hear people say like, oh, get a credit card, it'll help your credit score. Well, it's only going to help your credit score if you're actually using that card, because if you just have an open account and then you don't ever do anything with it, there's no history there to show, yes, this person is paying it back on time. It just shows you opened an account and never did anything with it. So what's important to note when it comes to length of your credit history is, yes, they are looking at how long that account's been open, but they're also looking at when you last used that account. So if you haven't touched a credit card in 5+ years, this is not impacting your credit score. Now, coming in at 10%, the fourth slice of the credit score would be your credit mixture. Okay, so this is where we look at the types of accounts you have. Do you have a mortgage? Are there car loans? Are there credit cards or revolving accounts? Retail accounts? All of that is looked at, and they want to see a mixture of different types of credit to show that you can balance all of those and kind of go from, just having a credit card to now we've increased their line of credit and now they have a credit card, but now they also have a car payment, and then can you juggle those 2 payments, and then, adding in a mortgage, so now you have credit card, car payment, and a mortgage. Are you paying them all off on time? Are you paying all of them in full each and every month? These are things they're going to look at. And while it's only a smaller portion of your credit score, it will impact you to some degree, especially if we were to compare 2 people with, really good credit history. However, different credit mixtures can change their credit score. And remember, the thing to note here about credit mixture, it doesn't mean go out and make sure you have one of everything. The most important thing when it comes to your credit score is that you're paying them off in full and consistently on time. So it does you no good to go out and take different types of loans if you're not using them or you can't pay them off in full and consistently. And the fifth and final component when it comes to your FICO credit score would be new lines of credit at 10%. Now, research has shown, and this makes total sense if you think about it really, people who go out and get a bunch of new lines of credit in a short period of time are more likely to default on their loans and are a higher risk for lenders. And there are 3 things specifically that FICO looks at when they're looking at your new lines of credit to determine this part of your credit score. The first and most obvious piece would be how many new accounts do you have? The second thing they look at is the length of time since you opened a brand new account. So if you opened a new account, just 4 months ago, that's going to be a little more negative than somebody who opened an account 4 years ago. And the third thing within this piece of the pie that FICO is looking at is how many times has your credit report been pulled in the last 12 months? Now, if you're going out and looking for some great mortgage rates, for example, don't worry. FICO has built it into their scoring system that you are allowed to get inquiries that don't directly impact your credit score. So, of course, shop around for some great rates. You want to do your homework. You don't want to just take the very first rate you are offered. So, always shop around, always shop your rates. And I just want you to remember that anytime you're taking out any line of credit, it is a really serious matter. Not just because, oh, it can impact my credit score. That's a whole other issue. But you are literally signing on a dotted line that you will pay this back, plus interest usually. So it's a really big financial undertaking, and it should be taken seriously. Do your homework. Do your due diligence anytime you are going to borrow money, okay? When you owe somebody something, there's a little bit of a weight on your shoulders, as opposed to when you say, this is mine. I owe it 100%. Thank you for watching. If you enjoyed this video at all, please give it a like. That would greatly help. And leave me a comment below. What kind of credit score do you have? Thanks so much for watching, and I hope to catch you on the next video.